to the Health Daily Show. I'm your host, Chitra Nabat. Joining us today is Marty Felsenthal, partner, Health Velocity Capital. Marty, thank you for joining us.
Thank you for having me.
Tell us all about Health Velocity Capital and what's unique and different about your firm and investing approach.
We are a healthcare-focused investment firm. We invest exclusively in innovative healthcare software and services companies with a mission of generating strong financial returns while contributing to a more affordable, sustainable, consumer-friendly healthcare system. We're really passionate about what we do. There are really two things that we believe make us different. One, at this stage of my career, I've really been investing in the sector for as long as almost anyone. I got started in the industry in 1996 as an investor, which has resulted in a lot of pattern recognition and battle scars. The second real key differentiation, in our opinion, is that we've been working with more strategic investors for longer than just about anyone in the industry. We have 16 large health plans and health systems that have invested with us, and about 95 current and former senior executives. Our LP base is the U.S. healthcare system, and we work collaboratively with them to make the system better, and not just our portfolio.
So you talk about being mission-driven, financial, making impact. A lot of healthcare VCs say that they're doing the same thing. We're also right now in a market where it's volatile, recessionary. It's taking VCs longer to raise less money. VC funding is down 50% compared to last year highs. So if you're that LP investor, whether you're an endowment or a strategic payer provider LP, what's your what would be your inside baseball or playbook that you would give the LP in terms of how to think about really discerning and evaluating VCs before they make that investment?
So I would give you two answers. One, in our opinion, this is a great time to be investing in healthcare. The entire sector is trying to realign towards a more affordable, sustainable, consumer-friendly healthcare system. There's a lot of pressure from employers and from government and from consumers to do it. At the same time, again, I've been doing this for 26 years. The sector's overfunded. I got started as an associate during the dot-com bubble. Probably luckiest thing that happened to me over the course of my career was that I didn't have a checkbook then. We had a 2000 vintage fund, top quartile fund, top performing fund of that, healthcare fund of that vintage year. We returned to 2x. Invested successfully through the Great Recession and then the aftermath of that. Generally speaking, in periods following bubbles, if we want to call it that, and we could debate that, the markets don't complete their fall for 3 or 4 years because we and our peers in the industry still have pretty strong, most of us have strong balance sheets, plenty of capital to invest, and until that capital works its way through the system, you're not going to really see a reset to reality.
So Marty, you're saying the supply of capital won't normalize for another 3 years. In this interim period, how should an LP really discern?
So I think that's also a really interesting question, and I'll sort of draw it back to our assessment of how we're investing. We began deploying a fund in 2017, late 2017. We made 10 investments between then and March 20, and we made 6 between August 20. We didn't do anything for that 5-month immediate post-pandemic period, in November when we closed out the fund. And we've had this conversation with our LPs and have been really transparent and honest with them. If we look at our first 10 investments pre-pandemic, on a standalone basis, that would be the best fund we've ever been affiliated with, over a 25 plus year career of investing. As we look at the 6 investments post-pandemic, again, very transparently, it's a mixed bag. And these are generalizations. We've got less than ideal companies in the pre-pandemic period and some fantastic companies in the post-pandemic period. But I think all investors, private company investors, public company investors, and limited partners really got away from the basics. And during that period, and I'm speaking, to ourselves, people certainly overpaid. There were times when people compromised on quality. There were times when investors became momentum investors. And I just think there was a little bit of scope creep. Some folks probably, jumped the shark on scope. Others, and I think this was true of us, again, being really candid, some scope creep. And I think the feedback I would have to LPs is back to the basics. Whatever. And I have no idea what's going on in the head of LPs. I'm grateful for the ones that have chosen to partner with us. Back to the basics.
You talked about this 25-year career in investing, 25 plus years, pattern recognition, less ideal companies, more ideal companies. Take us a little bit into your playbook or your pattern recognition algorithm. What are the metrics, the attributes you look for in founders or companies that cause you to invest?
So we've got a very specific style of investing, which you and I have chatted about before, and we're reasonably unique in our sector. We're trying to generate venture-type returns without the venture-type risk. We've had very few zeros over the course of our careers, very few loss of capital, and we've been fortunate to have ridden some strong waves. And so the characteristics that we're looking for fall into a group of different buckets. From a financial standpoint, we're looking for businesses with anywhere from 2 million of revenues to 50 million of revenues, 25% growth, more than a handful of customers to show proof of ROI, even if it's too early to have a study around it, a pipeline that we can touch and feel. That's one component of what we're looking for. The second component of what we're looking for is really our businesses that fit our mission and sub-themes underneath that mission: affordability, sustainability, and consumerism. And then the third component is we really only want to invest in businesses where we believe we can leverage our LP base and drive tangible value, revenue, which we've done in 95% of the businesses we've invested in. So that's one set of what we're looking for. On the more intangible side, CEO, and it's less a CEO who's been successful previously, and in fact, some of the worst mistakes I've made over the course of my career have been assuming that someone who was successful here will be successful there. Sometimes they were in fact great, other times they were in the right place at the right time. Our pattern recognition is somebody who works really hard, someone who is ultra competitive, someone who could, in theory, do just about every functional leader's job better than that individual, but doesn't. In general, we orient more towards sales CEOs than operational CEOs, because at the stage we're investing in, these aren't super broad management teams. So you do need a CEO who can do it all. And nothing's more important than getting the flywheel turning, sales.
Marty,
is that helpful?
Leadership. In career, in life, some would say there are rules, norms, codes on how things are done. Where have you been a code breaker in your career or life journey, and how did you do it?
So my rules have changed over the course of my career. I would say that when I began my career, I really assumed that because someone had been successful previously, they would be successful going forward. And I learned that that's not always the case through some mistakes, and all fine people. Over time, we started looking for those characteristics in a CEO that we just discussed. And I would say what I've learned the most, we're working with I joke, a CEO at a company called Well Health, recently rebranded to Artera. I think he's like 15 years old, which I say facetiously. I don't know how old he is, but he's definitely the youngest CEO I've ever worked with. And he's one of the best. He fits, and you could tell it, I could tell it when I first met him. Ultra competitive, great at sales, very high EQ, can absolutely, has the theoretical ability to do everyone's job, functional leadership job in the company better than, as well as, not better than, competently. And so I have broken rules. A back CEO, and this individual actually didn't even come from healthcare originally. And he's absolutely fantastic. And so that's a rule I've broken, and I'm really glad I did. The company's doing wonderfully. And I guess one of the things that I've learned is that it's less about a formula than it is, to a degree, I hate to say this, it's not so formulaic. A little bit of it is just instinct after 25 years. I think early on in a career, it's much more important to be a little bit more formulaic. And with experience, you can embrace some more flexibility, but not too much.
Marty, thank you so much for joining us.
Okay, thanks. Thanks for having me.